Good morning, everyone, and greetings from Winston-Salem. My name is Jason Cogdell. I'm with Chris McCauley. We are the benefits attorneys for ProBenefits, and as many of you know from joining our webinars, we're typically the hosts of the monthly client webinar, and we're happy to be with you today. Hope your summer is off to a good start. This is our 6th client webinar of the year. We will not have one in July as we take a short summer break, and we'll be back in August. We had originally planned for this session today in June to be a You Choose the Topic, where we submitted a list of potential topics along with a write-in option and allowed you to vote on it. We are actually going to do that in August. One of the reasons for doing that is that last month in May we did a compliance focus session on the key benefits compliance issues of 2016, and we got such a strong response to that session we decided to do today effectively a part 2, which is a practical planning for compliance for both the mid-year compliance deadlines, which we'll address today, and some other issues, and cover some questions that you all have submitted. So some questions have been submitted in advance of the session, and we're going to address those during the session today, and this will be a 30-minute session, and then we'll address some new questions that you have submitted as well. You'll receive in July both a survey, short survey regarding our webinars, and an opportunity to vote on the August topic. But if you'd rather share that via email instead, you're welcome to do that anytime with Chris or myself. So today's session is practical planning for compliance. By the way, if you didn't join that June session, which covered the key benefits compliance issues of 2016, there is a recording of that session available along with slides. We'll be happy to share that with you. We're not going to go back and cover those exact same topics. We're going to move forward, again as a part 2 follow-up today, but we'll be happy to share a copy of that session with you. So we're going to start with the mid-year compliance deadlines and then move on to some other compliance issues and submitted questions. This on the slide, this list is basically the benefits compliance issues that we covered in the May session, which in our opinion are the key benefits compliance issues for 2016. Keeping in mind that for those of you in HR and company management, that the number 1 compliance issue for you all may be the FLSA overtime rules, which change for all of us on December 1st. So that may be your number 1 compliance item overall, even outside of benefits. Many of you are dealing with planning steps for that at this point, as are we. And so that may be your number 1 priority. And so the benefits compliance items may take second priority. We understand that. And in fact, I think those new FLSA rules will have some impact on benefits since it will affect compensation and hours of employees, and we don't need to get into that today. That's on the list, and this list includes the other items we think are important in addition to those changes under FLSA that apply to employers for purposes of hourly tracking and overtime pay. So this is the list. This is what we covered in the last session. So we're going to build on this list to look at both the deadlines that are coming up soon, particularly July 31st, and look at some key issues for the remainder of the year. I'm going to go through a very quick overview of what the calendar looks like between now and December, and then Chris is going to share a little more information about the key July 31st deadlines, which are the PCOR fees that are due for self-funded major medical plans and HRAs, as well as the Form 5500 deadline for calendar year plans. Before that, this week is the final deadline for the first round of ACA reporting. Some of you were not required to report because you were a small group with a fully insured plan or no group health plan. Others of you were required to report, but you're already done because you submitted your 1094-C to the IRS in hard copy by the end of May, and that concluded your first round of reporting. Others of you are large groups, or you use a third party, so the deadline for the 1094-C for you is June 30th. That's the electronic filing deadline through the IRS's AIR system, AIR. June 30th is the final submission deadline, and there's no extension beyond June 30th. So there are many employers around the country who are working to get that form submitted this week, and we're just starting to hear about some of the bounce backs, the non-accepted forms, or the forms that are accepted with errors because of individual 1095-Cs that have Social Security names and numbers that don't match, or other items. But this is the final deadline for round one of reporting. Now, interestingly enough, for those of you who are required to report because you're applicable large employers, over 50, subject to player pay, subject to reporting, the next round of reporting is going to come quickly because these were extended deadlines. The IRS extended these deadlines by several months, but the deadlines revert back to January as the 1095-C deadline for the 2016 reporting that'll be due in early 2017, and then February/March for the 1094-C. So the good news is round one of reporting is about over. The bad news is round two is going to come right around the corner. But just a quick reminder of that June 30 deadline, which I'm sure all of you who need to report are well aware. Once we look past July 31st, and there are some intervening deadlines that I didn't list here, those that are certainly not new or different, including Medicare Part D credible coverage notices in October and those types of things. But the next key deadline from an ACA or compliance standpoint will be November 15th, when employers that are subject to the required reinsurance fees, this is the third and final year, which is good news, of the required contribution to reinsurance fee, and the fee has dropped significantly for this year. It's the last year, but November 15th is when the initial filing is due from self-funded major medical plans, because fully insured plans, the requirements on the carrier. Self-funded plans have to do the reporting. None of you who are self-funded are surprised because you're aware of that. That filing is November the 15th, and that's really the next big filing after July from an ACA or compliance standpoint. As we look at the July 31st deadlines, Chris?
Thanks, Jason. The first July 31st compliance topic I want to talk about is PCOR fee, which has circled back around again this year. PCOR fee is an annual Affordable Care Act fee that's applicable to major medical plans and other non-accepted benefits, the most prevalent of which are HRAs. So PCOR fees applies to these health plans. For fully insured plans, the requirement is on the carrier to report the fee and to pay the fee. So if you have a fully insured medical plan, this requirement is not something you need to worry about for that medical plan. However, the plan sponsors, the employer plan sponsors, are required to report and pay the fees for self-funded medical plans and or HRAs. And in order to do that, the plan sponsor must file IRS Form 720 by July 31st of each year for the plans that ended in the prior calendar year. And you report the number of participants on the form, submit the form to the IRS along with payment for your applicable fee. We do use the second quarter Form 720. A common question is, this is an annual fee. I'm paying the fee for a plan that ended in 2015. Why do I have to use a 2016 Form 720 that is identified as the second quarter Form 720? And the reason is really that's just the rules. The IRS says that this is how PCOR fees are paid. They are paid using the second quarter Form 720. I don't know if any of you are familiar with Form 720. It's a couple pages long. It has a long list of fees and taxes that some employers are required to pay, gas taxes, fuel taxes, coal taxes. Many employers aren't required to pay any of those fees, but they may be required to pay just the PCOR fee. And anytime you're paying just the PCOR fee, it gets reported on the second quarter Form 720. PCOR fees apply for 7 years. We're kind of in the middle of that time frame right now. The fee started for plans in 2012 and they will end for plans in 2019. So we have a couple more years of PCOR fees. The PCOR fee does not apply to certain non-accepted benefits, and that includes health FSAs and other benefits such as dental and vision plans that are considered exempt from some ACA requirements, including the PCOR fee. The fee is due again by July 31st for all plan years ending in 2015. This is another common question. So this includes all plans that ended in 2015, no matter when they ended in 2015. So potentially an HRA that began February 1st, 2014 and ended January 31st of 2015, which was a year and a half ago. That plan does have to pay the fee by this July 31st. So a common question is, this plan year that ended January 31st, 2015, ended a year and a half ago. Am I really supposed to pay this fee now for that plan? And the answer is yes. Again, that's just the way the rules are. That's how the IRS has told us to report and pay the fees. The amount in 2016 is either $2.08 or $2.17 per participant per year, depending on exactly when in 2015 the plan year ended. All plan years that ended prior to October 1st, 2015 will pay the $2.08 fee, and any plans that ended October through December of 2015 will pay the $2.17 fee. We have more information on our blog on our website. We also have a one-page summary of this topic that identifies the fees that will be paid for which particular plan years. So if you'd like a copy of that summary, we could provide it upon request.
Chris, a question submitted is whether PCOR fees for the self-funded major medical plans and HRAs are required regardless of the size of the group, or if there's a size exemption.
There's no size exemption for the PCOR fee. So regardless of the size, even if there's one participant, $2.08 would have to be submitted to the IRS.
Second question is, can you say a word about our preparation of the 720 for our HRA clients?
Yes, all our HRA clients have received an email from us regarding this topic. It included a completed Form 720 that has already been populated with the participant counts for the 2015 plan year. The client should review that Form 720. Our email also included instructions as well for submitting the forms and paying the fees. So our clients should review the 720 that we provided and then go ahead and submit it if accurate and pay the applicable fee. One note about how participant counts are calculated: there are specific allowable methods of how you count the number of participants in a year. The method we use is called the actual count method. So participants covered for a full plan year are counted as one participant. Participants covered for part of the year can be counted as only a fraction of a participant. So it is possible to have a participant count for PCOR purposes that is less than the actual number of participants that was covered at any time during the plan year.
Sounds good, Chris. I've tried to answer the remaining questions. We got a number of PCOR questions and try to answer those. We'll be happy to provide our one-page summary. Chris mentioned our blog post, and also we've gotten some questions about some groups that may need assistance with PCOR who have a self-funded major medical plan that the TPA is not assisting them. If you're in that situation, we can help you with the Form 720. We've done that for some groups before, and we'll be happy to talk about that with you offline. So these are we're going to try. Go ahead.
I was just going to make one other note about the PCOR fee and self-funded medical plans. If there's a group with a self-funded medical plan and an HRA, you don't have to pay the fee for participants that are covered by both plans. You only have to pay one fee for participants covered by both plans. So an individual that's covered by both the self-funded medical plan and the HRA, you only have to pay the fee once for that individual.
Yep, agreed. Last question, and then we'll move on. Can you clarify whether the participant count that is multiplied times the fee is the number of employees only, or the number of employees plus covered family members?
That rule depends on the type of plan. HRAs only have to count the number of employees that are covered by the plan. Self-funded medical plans are required to count both employees and covered dependents. So it does depend on the plan. If we're talking about the HRA, you just need to count the number of employee participants.
Yeah, got it. Okay, thanks, Chris.
Form 5500 reporting is the next big July 31st deadline I want to talk about. We talk about Form 5500 reporting regularly in our ERISA presentations. As we've said in the past, the Form 5500 is required for health and welfare ERISA plans with 100 participants as of the first day of the plan year. So unlike PCOR, which only applies to health plans, Form 55 reporting applies to all health and welfare plans subject to ERISA, including disability plans, life insurance plans, certain accident or cancer plans. So all plans subject to ERISA with 100 or more participants as of the first day of the plan year. And those forms are due to be filed with the DOL by the end of the 7th month after the plan year ends. So this is a distinction between the PCOR, which is the deadline is always July 31st. Form 5500 reporting deadline depends on when your plan year ends. The reason we're talking now and talking about it as a July 31st deadline is because calendar year plans, which are certainly the most prevalent plans that we see that end December 31st, 2015 are due by July 31st of 2016. So your 5500 deadline may differ depending on when your plan year ended, but for calendar year plans, the deadline is July 31st, 2016. If you don't think you can get your 5500 reported in time, there is a 2.5-month extension that is available and is automatically granted by the IRS as long as Form 5558 is submitted prior to the July 31st deadline.
Chris, can you say a word about late filings or missed filings?
Yes. So if there is a delinquent filing, you are still required to file the form even if it's delinquent. Late filings can be assessed a large penalty by the DOL. That large penalty is $1,100 per day of delinquency. So that's a very harsh penalty. The DOL does have discretion to assess a lower penalty. But another option for late filers, rather than waiting and hoping the DOL does not assess a large penalty, is to essentially make the late filing and also pay a lesser penalty through the DOL's delinquent filer program. Essentially, the employer raises their hand, says, we should have filed, we didn't file, we're going to file now, and we're going to pay a lesser penalty, which is capped at $10 per day or $4,000 total. So that's one way to lower your liability significantly for a late filing, is to go ahead and file through the delinquent filer program. All filings are required to be done through the DOL's EFAS system, so that is the method for filing the 5500 forms.
Thanks, Chris. And I think I've gotten to all the questions that have been submitted so far. Our next segment is answering questions that you have submitted along with some FAQs. And if you'd like to submit some new questions, feel free to do that through the question box during the session, which we'll get to, or to email to Chris later. The next series of questions are questions that have been submitted for this webinar, and I'm going to cover them one by one and not spend a ton of time on any one of them. More details are certainly available if you'd like to hear, but these are questions that have been submitted by you and are common and frequently asked questions about hot topics that likely relate to everyone. Question number one, what about the CMS DataMatch letter and questionnaire that we received? Is it legitimate, and what do we need to do? First of all, this is a legitimate project of CMS. CMS is the Center for Medicare and Medicaid Services that, among other things, enforces the Medicare secondary payer rules, which are strict. And even though there are options, for instance, if we've got an active employee who turns 65, we need to allow that employee to still be eligible for the group health plan. If it's a full-time employee, that employee could waive the group health plan in favor of Medicare, but the employer is prevented from incentivizing or rewarding him from doing so. And so in order to enforce the Medicare secondary payer rules, CMS is launching this project right now. I don't know if they've started it right now. They probably started at some point in the past, but they're just getting around to the questionnaires, which are legitimate, at least the ones that I've seen. There's a formal explanation on the CMS website if you'd like to read more about it. There are also some good articles online about what employers should consider as they deal with these questionnaires. But our recommendation would certainly be to take them seriously. Consult your broker generally about your plan, about any potential MSP issues you may need to address to prevent any liability. But that's the short answer on the CMS DataMatch letter, and I would direct you to the CMS website for what is a short but effective explanation of that project from CMS so that you make sure you're heading in the right direction on that. Question number two, what is the status of the Form W-2 reporting requirement for group health coverage? And specifically, does the transition relief that currently applies to small groups still apply for the 2016 W-2s that we'll issue in early 2017? First of all, I want to distinguish the new W-2 requirement, which has been around since 2013. I want to distinguish that from the IRS reporting 1094 and 1095 forms that are part of the employer mandate. This is something different. This is a requirement that technically every employer would, on the W-2, this is one of the sub boxes on the box 12 lines, would report the total value of employer provided health coverage. So the amount of tax-free health coverage provided to that employee, both the employer dollars and the employee dollars, whether that's health premium or any other applicable health coverage for the employee, that number would go in box 12 of the W-2. It doesn't make it taxable. It's just a informational reporting mechanism to the IRS. Is technically tied to the Cadillac tax, so that this is the item on the W-2 that the IRS would use to enforce the Cadillac tax, which was going to be effective in 2018. It's now been delayed until 2020. So that's the reason we have this. But this is applicable to every employer of all size. But there's transition relief that currently applies to employers that issued in the prior calendar year less than 250 W-2s. So if the employer issued less than 250 total W-2s in the prior tax year, then it does not have to comply with the W-2 reporting for the current tax year. And doing the W-2 reporting, which some small groups do because it's just built into payroll already, or payroll's already set up to do it, is completely voluntary. But that transition relief still applies. So it still applies for 2015, for 2016. It looks like it will apply going forward. So just to confirm, if you're an employer that issued fewer than 250 W-2s for 2015, several months ago, then you do not have to do the W-2 reporting for 2016 W-2s, regardless of how many you issued. We're always looking back to the prior year, and it looks like that transition relief will apply at least until the Cadillac tax applies, if it ever does. So short story here, there is a W-2 reporting requirement. I'm aware that some large groups are not yet complying, and I don't think the IRS has necessarily cracked down on it yet, but large employers need to be doing this. And it's probably less important that the data is correct than it is just that employers actually have something in the box. But we want to do it right if we're a large employer. If we're under 250 W-2s, we've got this transition relief that'll allow us to avoid it for the next few years if we choose to do so. So that's the status of the W-2 reporting requirement, and if any more information on that would be helpful, we'll be happy to provide it. Question 3, is it true that employers will be receiving in 2016 marketplace notices for employees that are approved for subsidies? And the answer is yes. At least in theory, the answer is yes. I haven't personally seen any of these notices other than a sample, but in theory, if an employee of your organization has gone to the marketplace, applied for an advanced premium tax credit or a subsidy, and been approved for the subsidy, and as part of that process, there's an employer coverage disclosure statement where the employee is supposed to identify who the employer is and whether or not he or she was offered coverage. So if someone identifies your organization as the employer, whether or not they said you offered coverage, whether or not you did offer them coverage, then technically the marketplace is supposed to contact the employer, give them a notice, and we have a sample available if you'd like to see it. It basically says, employer, this employee has been approved for a subsidy and will be receiving, subsidized coverage through the marketplace. If you know of a reason why he or she should be ineligible, let us know. And this allows the employer to know if it's someone that should have been offered coverage that wasn't, then that's a potential player pay penalty. Or if it's someone who was offered coverage and affordable employer coverage was offered to them, then they shouldn't have been subsidy eligible. The employer can let the marketplace know, so the marketplace can deal with the subsidy and potentially avoid the problem where the employee gets the subsidy, is really not eligible, and then has to pay it all back at the end of the year. So this notice is not necessarily a bad thing for employers. It could help us as employers protect ourselves, but it is one more action item. I'm not sure of what the time frame is. I think the employers have 30 days to respond to the marketplace. But employers need to be on the lookout that these notices may be coming. If you're a small employer not subject to player pay, you may still get this notice, but then the notice, is really not about employer penalties. It really is more about the eligibility of the individual for a subsidy and whether or not that person should be receiving a subsidy. But we need to be on the lookout for these notices as we proceed in 2016. And by the way, if you get one or have gotten one, I'd love to know it and love to see what you actually received. Question number 4. Where do we stand with spousal exclusions for health coverage? This is a topic that's been hot for a couple of years now, and it only gets hotter. Question from employers: do we have to offer coverage to spouses of our employees? The answer to that depends on group size, because, for example, groups that are under 50 are generally required to offer coverage to spouses by state law. As an example, here in North Carolina, we have a state small group insurance law that requires any coverage that's offered to an employee to also be offered to the spouse and dependents. So even though the ACA does not require spousal coverage, it does require dependent coverage, but it does not require spousal coverage. In our state, small groups have to offer coverage to legal spouses, and that's the case in other states as well. For larger groups over 50, they've got the option to exclude spouses. So some employers want to exclude spouses altogether, not allow any spouse to be covered. That is an option, but there are legal considerations, particularly ERISA. Some employers want to have spousal surcharges that, spouses, if you are eligible for other group coverage, then we're going to charge you more than a spouse that's not eligible for other group coverage, because we'd rather you be on your employer's plan than ours. And then the other option would be to disqualify spouses if they have other group coverage. So the 4 options, the 4 basic options for employers are: number 1, cover the spouse as always, and if you want to discourage enrollment, do it with rates. Option 2, exclude spouse altogether, which small groups most of the time cannot do. Large groups have some options. And the other 2 options are either the spousal surcharge or spousal exclusion based on other group coverage. So employers are examining spousal coverage options. Most employers examine the options and decide to go ahead and allow spouses, but this is where we stand. And the key is that if the employer wants to have a surcharge or an exclusion for spousal coverage, it just needs to examine all of its legal considerations and make sure the eligibility in the plan SPD and other materials is consistent with the eligibility practice of the plan, to make sure that there are no problems there. So that's a short explanation of where we stand with spousal exclusions. Question 5, have the 2017 amounts and limits been announced, for example, for player pay and affordability? Most of the 2017 amounts have been released by the IRS. As an example, the affordability percentage for player pay purposes for employers will be 9.69%, a very small increase from the 9.66% that applies this year. The penalty amounts for next year, which are indexed, have not been announced. The HSA limits and amounts have all been announced. They're basically identical for 2017 as 2016, with the only minor difference being a $50 increase in the individual contribution max from $3,350 to $3,400. The health FSA max, which is $2,550 for 2016, has not been confirmed for 2017, but we expect it to either be the same or go up to $2,600. And if you'd like more information on the 2017 limits, we'll be happy to provide that to you. Chris, any other questions submitted? I know we're starting to bump up against time here.
Yeah, one question about back to the spousal coverage. There was a question that said, so small groups can surcharge spousal coverage, they just have to offer coverage. So I guess this is the question is that the small groups may have to offer coverage, but can they surcharge that coverage?
Yes, there's really not a limit for small or large groups on the premium that is charged for spousal coverage. So it's even a small group that's legally required to offer spousal coverage could implement a surcharge if other group coverage is available, or could simply just, charge a high rate for spousal coverage to, provide a disincentive for enrollment. That's right.
I want to go back and answer one common question again we receive about PCOR fees, especially for our HRA clients. One common question, especially from our HRA clients, is we did not receive a 720 this year. What was the reason for that? And one potential reason for that, and a common reason, is that we just started administering your plan in 2016, or a plan that is going to end in 2016. So if we did not administer your HRA prior to the plan years that are ending in 2016, then we don't have the information about previous HRAs, whether it was offered, and the participant counts. So that's one common reason why one of our HRA clients may not have received a Form 720 from us.
Thanks, Chris. In your interest of time and preserving your time and day, we're going to stop there. If you would like to submit a written question, Chris and I will hang around for a few minutes and address your question through the question box. Otherwise, you're welcome to send an email to Chris at Christopher@ProBenefits.com. As always, thanks for your participation. Hope you have a great day, and we'll talk to you soon.